Hey everybody, welcome to the Narwhal Capital Management quarterly macro presentation. I'm Andrew Hall. Joining me today as well is Narwhal's senior equity analyst Benjamin Nye. Ben will be joining us in just a few minutes. But this is the second quarter doing this, so if you watched the first one, you kind of know the drill. But today we're going to be looking at a couple different things. First things first, we're going to do a quarterly review. Take a look at things like the equity markets, look at employment, inflation, and also drill down a little bit on sector performance. From there, we're going to look at a couple topics that we felt were pertinent as we look at where we stand right now in the economic landscape. So we're going to look at debt, demographics, CapEx, and the expectation there, as well as some expectations on taxes, tax rates, all that good stuff, and then we'll wrap things up. So jumping right in, one of the first things we always try to do is establish where we are within the market. And most of the time when people talk about the market, more often than not, they are talking about equity markets. So right here we have the S&P 500 and what it has done year to date. Obviously a nice little run. We talked about the first 6 months of the year the last time we did this, and you can kind of see where we picked up and where we continue to go. Continued to run up in the early parts of July, a little bit of a pullback going into August, and then continued marching upward. As most people know, since the quarter ended, there's been a number of new highs set, things like that, big Dow benchmark, all that good stuff. So market is continuing to run up, and investors, I think for the most part, although they're being cautious, they are enjoying the fruits of those returns. Interestingly, as we look a little bit further back since the year 2000, you can really see the old peak of 2007 moving into 2008, and it doesn't seem like a peak at all anymore. And what's interesting about this is, had you invested at that level, even at the top, you can really see an incredibly impressive return, especially when you take into account dividends and things like that have come your way. So even if you invested at the very top of this thing, we were at a conference, and one point that they were making repeatedly is that you've actually doubled your money since that time period. So it's kind of interesting to see that in a little bit of a different perspective. The other thing I think that's worth noting is, again, the length of this up run. We talked about this in the last quarterly presentation, but to see a bull market stretching through 09, 10, 11, 12, 2013, 14, 15, 16, and now 17 is really an impressive run in terms of duration. So something to keep in mind. And the last point I would make here is just one of application. We hear people ask all the time, why would I invest here? Shouldn't I wait? You can certainly try to time the market. That's not something we would recommend or advise, but the reality is most people invest because they expect markets to go up. So again, even if you invested at the highs in the year 2000 or the highs in 2007, you're still making money through this market as we continue to push ahead. We don't necessarily think periods of low volatility guarantee a market pullback. I mean, we certainly have anecdotal evidence and things we can see in which volatility has been low, and shortly thereafter we've gone into a bear market, but that's not necessarily a guarantee. And as we look ahead at some other measures, we can see again, volatility for the index of the S&P 500, it peaks and it comes down, and we're certainly in a period of low volatility now, but historically speaking, we've had a lot of periods of relatively low volatility. So you can see that here, and you can see the frequency with which these things have happened. 2/3 of readings show volatility under 15, 4 out of 5, so 80% show volatility under 20. So low volatility, again, it's rather common. It's not something that's terribly unique, nor is it necessarily a guarantee of a pullback within the markets. Another thing we certainly keep an eye on here is employment. When we think about the markets and we think about the economy, employment is something that we're very much paying attention to, and you can see a lot of continued good news here in some regards. But I would draw your attention to the spike that we have, kind of coming here in July. This really is the result of hurricane season and troubles tied there too. This could provide some excuses as we look at capital markets, at equity markets in particular. We could find some cases in which earnings are missing because of hurricane season, but the reality is we do view this as something more of a blip, not necessarily a trend. We're not changing our outlook on the economy because of hurricanes. That's not something that we view as totally appropriate, and we do expect this trend to continue to go, hopefully, in the right direction as it relates to jobless claims, things like that. And a longer trend along those lines is we are continuing to see, stability on the participation rate as well as unemployment rate. We're really satisfied with that. We're not, seeing this disconnect between the two. We're not seeing something that seems unsafe or unlikely to be maintained. At this point, certainly we see unemployment, which is the green line right there. We see that at a low level, but we don't know that this is necessarily going to spike right back. In fact, I think in some regards, Ben and myself would argue that it could continue to stay relatively low.
Yeah, I think that's exactly right, Andrew. And this has Ben here. When you see an excess, or what appears to be an excess like this, sometimes it is tempting to say that that excess needs to be resolved immediately. But the fact of the matter is that if markets just retraced every single time they reached a new high, or the unemployment rate bounced immediately back up every time it reached a new low, then we would never make any progress. So I think one of the important pieces to note in this instance is that excess does not necessitate a catalyst. And here the catalyst would mean that something changes in the near term, and you can't necessarily predict that just simply by identifying an excess.
Yeah, and Ben's exactly right there. I think sometimes it's really easy to try to find a pattern and say that this pattern will continue to replicate. It's important to be aware of these things, but not necessarily because they're going to mandate a certain trajectory in the future. And here we have something kind of similar with that, looking at ISM employment measures. Manufacturing strength has continued despite a stabilization in the oil price, which is something I don't think people necessarily expected. When people point to the reason that maybe the economy was struggling some in 15 and even into 16 sometimes, people were a little bit hesitant to recognize the rebound that we've had there. And so manufacturing strength is not just an energy market rebound that we don't think at this point. So again, a trend that we've been able to kind of take a step back and watch continue to develop. Here you can see both the manufacturing, that's the orange line, as well as services, the green line for ISM, and both again continuing to trend in that right direction.
And Andrew, on to that point, we were at a conference where Ben Bernanke was speaking, and one of the things that I thought stood out to me was that fact that he thought that the blue-collar wages, the manufacturing wages, had actually performed fairly well in the recent years, and that would go coincident with the ISM manufacturing number. He said that the higher skilled or white-collar jobs had seen less of the wage increases, and that growth was more concentrated in the blue-collar economy, which I don't think many people are talking about, and I was surprised to hear Bernanke say that when he spoke at this fireside chat. If we move on to the S&P 500 sector performance here, it is really stark. In fact, you could have lost 11.5% this year if you were just only invested in energy stocks, but you could have made almost 30% on a year-to-date basis if you were only invested in technology stocks. This is a market where there is significant divergence among sectors, and there's also significant divergence within each sector. I mean, you could buy very good technology stocks, but there are also some really bad technology stocks. And that's the same in healthcare. Healthcare is traditionally very divergent, but it seems especially so this year with a lot of drug approvals and a lot of drugs that have not been approved. Telecom also has been a poor performer, but in Q3, really, the status quo maintained with the exception of energy and healthcare. Energy, which had been a very weak performer year to date, had a little bit of a rebound with a return to inflationary tendencies in the economy. And healthcare, which had performed very strongly, started to retract a little bit on a relative basis, just as with the concerns about regulation and the politics of potential healthcare reform. So now that we've kind of recapped markets, we'll move on to some of the forward-looking indicators of markets, and that includes inflation. So what we've seen over the last number of years is that despite the interference of the Federal Reserve into the monetary policy, the Federal Reserve's balance sheet is currently about 23% of GDP. It did reach about 25% of GDP a couple years ago. Despite all of that, inflation has actually remained remarkably stable. The green line is unadjusted for commodity prices like food and energy costs, which are historically extremely volatile and can muddy the data. The orange line is adjusted by excluding those commodity fluctuations. What we've seen is that we're very close. In fact, we're a little bit underneath the 2% line that would satisfy the Federal Reserve's mandate for price stability. So what does this mean? It means that the Federal Reserve is going to have more confidence with its policy. It means that what we've had over the last 5 years has not, as yet at any rate, it has not resulted in that hyperinflation scenario that many people had feared just a few years ago when we were doing the QE1 and then QE2 and QE3 and printing all this money. And in fact, the economy just continues to improve. So on the household debt to disposable income, we've seen the debt and the debt funding ratio decline for many Americans and Americans on the aggregate. Now, debt is still higher than disposable income, which means that if you have $125,000, you might have a $125,000 mortgage and you might have a $110,000 income. That would mean your debt's higher than your disposable income. However, that has also come down dramatically from the periods of the 2000s. And importantly, what we're not seeing is we're not seeing a slope upward in that line. We're not seeing a return to those excesses of the past. In fact, credit card delinquency rates are down, both on a 30-day and a 90-day basis. If you listen to a lot of these conference calls that the banks have after their quarters are completed, you'll actually see them talking about they want to increase the credit card delinquency rate because it means they're not taking enough risk at the present time. They're leaving some money on the table because they're so stringent on who they extend credit to that they're missing out on some margin opportunities in that regard. So if you look closely at this chart, you can see that the delinquency rate on credit cards in aggregate for 90 days is just 0.74%. And even on a 30-day basis, it's just between 1 and 2 out of 100, which is quite low historically. If we move on to mortgage delinquency rates, that continues to come down. That is still higher than we would probably like, but we've returned to about where we were in the mid-2000s. And again, if you look at the excess, I mean, you might have wanted to identify an excess in mid-2006 when you started to see a rise in that mortgage delinquency rate, but the market continued higher for about another year before we really began to crash. And this is admittedly a lagging indicator. You can see that the mortgage delinquency rate peaks subsequent to the crisis, which makes sense. You would tend to see higher mortgage delinquency rates when you enter a recession. Nevertheless, this downward trajectory is certainly on the right path, and we'll look for that for that to continue as a sign of a strong economy. Auto loan delinquency rates, however, are not so sanguine. In the recent couple of years, we've seen companies extend credit to borrowers for buying vehicles, both through leases or through auto loans themselves. And we have started to see tick-ups in that auto loan delinquency rate, which is interesting because a number of financial institutions, including most prominently Wells Fargo and JP Morgan, are really pulling back on extending auto loans. JP Morgan, in their most recent conference call in October, said that they're seeing some stabilization in auto loan delinquency rates now. This data that we have, unfortunately, is only through June. So I'm looking for this to stay relatively contained, but it is something that we need to watch out for, especially as it relates to the manufacturing sector of the economy and the auto manufacturing sector specifically. One of the concerns that the banks cited when they were talking about the progress they're making in the business and the growth they're seeing is that they are seeing slower growth in commercial and industrial loans. This means when they're extending fewer loans and there's less demand for loans, it means that there's less opportunity for the banks to make profit opportunities. So you're starting to see that flat line over the last year or so. And what we would like to see is that continue to move upward, not extremely rapidly, because that would be indicative of a bubble, but we would like to see it move up sedately and in line with how well these commercial businesses are doing. If they're pulling back on getting financing, it suggests that they're also pulling back on investment, and we want to see them invest in the economy. We want to see them invest in their business for future growth. The big number, though, that a lot of people will point to is the U.S. public debt outstanding, and that is 20 trillion with a T. And that debt limit has recently been raised, and it looks like we're about to have another big deficit in this coming year. This is a issue. It is an issue, but it's been an issue for a long time. It was an issue in 2008 when the U.S. public debt was less than 10 trillion, and certainly an issue now when it's more than 20 trillion. But if you wanted to herald the American apocalypse, you could have been doing that in 1990 when the U.S. federal debt to GDP ratio soared from about 30% in the early 80s to about 60%. It had more than doubled. Of course, now we've had this latest big run up from about 60% to 103%. So what does this mean? It means that if all the value created by the American economy, all the businesses, all the income that was produced in the United States was just given to the federal government, we still wouldn't be able to pay our debt. We'd still have a debt of 3% of GDP. So that's the magnitude of our situation, and it's not healthy. But what's also not healthy is Japan's debt to GDP ratio, which is over 200%. So just to make a claim that we're about to have an imminent crash because the federal debt to GDP ratio is some arbitrary number, admittedly some very large number, making that claim that we're going to have a crash is not necessarily backed up by history. The U.S. federal deficit as a percent of GDP is concerning because we want to see the federal deficit decline as a percentage of GDP as the economy improves. In good times, when your GDP is higher, you should see this move closer to zero or hopefully above. We did run a surplus in 2000, and then we've of course had the recession and the Bush tax cuts, which drove us back into deficit. You don't want to be moving high into deficit necessarily when the economy is improving. And this is especially salient right now because we're looking at cutting tax rates. U.S. federal income tax receipts are surprisingly less than 10% of GDP. Now, what does this mean? It means that of all the value that we create in the United States economy, the federal government only collects less than 10%. This is a good thing if you make money in the United States. It's a bad thing if you're the Treasury Department of the United States. And historically, we've never really collected more than 10%, at least in the post-World War II time period. Even when the marginal income tax rates were extremely high in the 1960s, we weren't collecting more than 10% of GDP. So this is important because it means that we do have somewhat of a lid that is played out historically of about 9.5% to 10% of GDP in collections. And if we're looking for more tax cuts, we could see that decline again, which would hurt the federal balance sheet, but be good for workers overall. Okay, I wanted to hit demographics today because that's been in the news a lot. There's been a lot of talk about potential GDP and that how the United States has to be content with a lower level of GDP in the future because of the demographics that we have today. We obviously have the retirement of the baby boomers, the pending retirement of the baby boomers, and a new millennial generation that seems intent on not working. And I think there are some parallels that we can draw with Japan, which is often cited as the cause for bearishness as a result of adverse demographics in the United States. So the best way to look about this is say, okay, well, what does the United States look like versus Japan in terms of a population chart? Well, we can see that in 1950, Japan's population had a very large number of young people and a very small number of old people. And that was similar, although less pronounced, in the US in 1970. Large number of younger people, aged 5 to 15, and a small number of old people. And that has continued today, not surprisingly, as that population has aged. We have an echo population that was existent in 1997 in Japan, supporting that large bolus of population who are approaching retirement. Similarly, in the United States today, we have a large number of people in the 20 to 35 age group, and a large portion of their parents, about 30 years older than them. And this is an interesting point to note, because now we have that new generation having to support the older generation. What's different in Japan is that we do have more of a pronounced disparity in the size of the younger population versus the size of the older population. That'll be important to bear in mind. The second thing that's a huge difference between Japan and the United States is the fact that Japan is extraordinarily xenophobic, just on the numbers of it. I'm not talking about the people necessarily. But on average, over the last 50 years, they have lost 4,000 people to migration every year. In contrast, the United States, on average, we have data going back about 35 years, has gained almost 4.5 million on average per year. So if Japan is losing a small percentage of its population every year to migration, and the United States is gaining 1 to 2% of population simply through migration every year, then that helps to phrase some of the concerns about the demographics and the doomsayers who say that America is essentially dying off or getting very sick and getting very old in aggregate. And we would say, well, they're actually bringing in a larger portion, about 4.5 million a year, of new blood into the United States that can invigorate the economy. Obviously, there are concerns with potential immigration shutdowns, but the data over the last number of years is fairly persistent, and we would look for that to continue, especially if you're approaching this from a bullish perspective.
Ben touched on demographics, and I think looking at Japan is a perfect way to kind of see, hey, what's the expectation versus what's reality? And again, sometimes you get these themes that can become almost second place in your mind. I mean, they just get ingrained. You think of them all the time and you assume them to be true. But there's a little bit more nuance to economic data a lot of times than I think people really want to see. It's really easy to make a case, either positive or negative based on what you see. And I'm sure we're as guilty of that as the next guy. But what's interesting when you look at the age of this population and demographics are really the trends that we can see here over the last 17 years in terms of the working population. You know, we can see at the very bottom, if you're looking at that orange line, the percentage of the working population between the ages of 55 and 64 has increased quite nicely. That's a solid amount of increase to go from, around 10% to, close to 18%. On a relative basis, moving up close to double in terms of that population. So you are continuing to see that. That is a trend that you would expect to swing one way at some point, but at the same time, we know that we have a large aging population, and we see that vesting itself. We also see that the younger population, we've actually seen some declining, both in the age group of 25 to 54-year-olds and the age group of 15 to 24-year-olds. And as we go, to look at the next slide here, it's easy to actually see why some of this is happening. Ben mentioned the young millennials that don't want to work. Well, there's 3 millennials, unfortunately, in this room, and we have to work. So we're actually working. But what's interesting is the percentage of high school completers who are enrolling in schools for either 2 or 4 year degrees, and you can see a staggering increase in that. And you don't have to be, the most brilliant economist in the world to understand that if 70% of a certain population is in school, then that 70% is probably not employed, certainly not employed full time. So you can see some of the factors that are weighing on that. There's also been a large increase in people getting post-baccalaureate degrees over the last several decades.
Yeah, and Andrew, I would just chime in that I think that you could almost look at this data bullishly. So if you look at it as we've never had a more educated young potential workforce than we have today. We have a lot of pent up human capital supply. And we have all these people who have, instead of joining the workforce immediately, have been in college, and yes, their development has been delayed. And yes, there are many people who aren't progressing the way they should. Having said that, I think in aggregate, if you think that education furthers growth in the economy and productivity in the economy, then this chart is something that should make you very bullish on the economy, not bearish, because we haven't even tapped into a lot of this pent up human capital supply yet.
Yeah, that's a great point, Ben. And as we look at, kind of segueing to a slightly different topic, but when we talk about things where we can't quite figure out what's pent up and what hasn't come to fruition yet, I think CapEx is actually an area where there's a little bit of frustration, going through. We've been to a number of conferences recently. You mentioned the conference with Ben Bernanke. I was at a conference up in Philadelphia not long ago. And one of the common themes I think we've heard across different conferences is the fact that we're not quite sure when the CapEx spending is actually going to start hitting and what the impact will be. Because as we look back at, the quantitative easing and all those factors and monetary policy enforced by central banks, not just the Fed, but central banks around the globe, what's been missing is really kind of this private investment and this growth within companies. And so here we see CapEx forecasts. You can see the Philadelphia 6-month outlook as well as the Richmond annualized CapEx. And you can see, again, especially on the annualized basis, you can see a little bit of a downtick in 2017. Even if you're looking at the 6-month outlook, it peaked a little bit ago and now it's pulled back really since where it was in July. And so we're continuing to wonder, we're continuing to expect for this spending to start to come in and show itself more in spades. But for now, still a little bit of a waiting game. And as we zoom in on this data, on the next slide, you can see, what has happened. And we have seen a little bit of change. And I don't know how pronounced it actually is. You could probably see this through two different lenses. But that red line that we have right there is really, the time at which Donald Trump took office. And you can see a bit of an uptick. We did not include it here, but CEO, actually we do later, but CEO confidence is a great indicator of this as well. When you start to look at companies that are thinking about spending more money on CapEx, investing in their businesses to grow and to take those next steps necessary to be competitive in the marketplace, that's going to be pretty closely tied to CEO confidence, which we'll touch on in just a minute or two.
And just to pull back a bit on why CapEx is so important. So capital spending is when you buy equipment that has a long life. So this is not when you spend to buy the latest Salesforce.com marketing software. It's not to redo your whole Microsoft Windows system. This is buying a new factory because you want to invest. It's building infrastructure. These are big spending projects that should have an immediate impact in terms of spending and therefore income. And it should also have a longer tail impact because of the benefits that capital investment, that infrastructure brings forth over the next ensuing time period. So that is why capital spending is so important, because this is essentially bets that companies are making that demonstrate optimism and the fact that they are looking forward to growth rather than looking over their shoulder hoping that they don't get bankrupt and don't get fired.
Yeah, that's a great point, Ben. And you can see, in some regards, you can see this. Here we have U.S. construction put in place, and you can kind of see that positive trend, and another way to look at kind of that investment, looking at what they're doing. You can see residential as well as non-residential and even infrastructure. What's interesting here is, we hear so much about the infrastructure bill and the things that Trump wants to pass. And we're really not seeing a whole lot of growth there. We're seeing very strong residential growth. I think most real estate markets here locally in Atlanta have seen that continued improvement. And so you can see that reflected here. But also interesting, I think, is about as interesting as any of this is the non-residential building, because you tend to associate that more with broader economic growth and these things working very much together. So it's interesting to see kind of that continued improvement. And as we talk about investing in your business, the next chart on the next slide really shows this CEO confidence. I mean, you can see where it really bottomed out there in 2009, and it's risen quite a bit. I mean, it's interesting. It rebounded relatively quickly. It'd be interesting to overlay this with an S&P 500 chart or something like that. But what's interesting is it seemed to rebound relatively quickly from 2009, but then it really just kind of floated for much of the 2010 to 2015 and 2016 period. But you can really see a pronounced uptick at the end of this chart, since mid to late 2016. And a lot of that, we are hoping, as we hope for GDP growth, a lot of this we hope will start to show its expansion, through CapEx and things like that. Here we have, quickly we'll go through new orders. You can see again a little bit of an uptick towards the end of the most recent period, both on the manufacturing and the services side, and also the Dodge Momentum Index, which is something we went into a little bit of depth on in terms of explaining when we were looking at this in the last quarter. But again, you can see this similar rebound from the bottoms of 08 and 09, and then yet again another area in which we're seeing a pronounced uptick really this calendar year and continued growth there.
So I think what we're seeing really, this is Ben again, is that we're seeing a lot of this soft data, the confidence numbers, the CapEx expectations. We're seeing a lot of that manifest itself in the data today, but we're not seeing it pronounced in actual spending. In fact, last year we saw a downtick of 1.6% in private investment. This year, economists only expect 3.6%, which sounds good, but it's still lower than anything from 2010 to 2015. And same if you look out in 2018 and 2019, we're only looking at 4.2 and 3.8%. Despite this confidence, despite the CapEx forecast from the various Federal Reserve banks, we're not seeing economists factor this into their GDP expectation. And this is a significant factor as to why the GDP forecasts are so low. This is why we are not at 3 or 4%. It's why we're at 2, maybe 2.2%. So if you want to become bullish on the economy, you're going to have to become bullish on private investment. And there really isn't a way around that equation. And economists aren't bullish on capital spending. In fact, even with those big upticks that we saw in the confidence numbers, those big upticks that we saw in the CapEx forecast numbers after the election, we're only looking at about 1 to 0.2% increase in the expectation of capital spending in 2018. Again, if you think that the American economy is going to surprise to the upside, you are saying that this number, this 4.2% for 2018, is too low. Part of what has given CEOs more confidence in the economy is not taxes. Taxes has been almost a head fake in terms of where people are looking and what is actually happening. Where people are looking is, well, I hope I get a 20% corporate tax rate. What is actually happening on the ground at companies is that their regulations are easing and they're easier to comply with. Mike Corbat said as much in the third quarter Citigroup call when he said what we are seeing is regulation adjusting course to accommodate higher growth rather than a full-scale regulatory repeal agenda. This is not a slash and burn strategy where they're just doing away with all the regulations that exist. This is seeing what regulations exist and adjusting them, modifying them in order to change that balance and shift that balance a little more to the corporations for them to invest. And Mike Corbat likes what he sees. In fact, no one really thinks that corporate tax rates are going to happen. I did an analysis of the number of companies mentioning corporate tax rate during their earnings calls. Companies report earnings every quarter, And in that, you can search for corporate tax rate. Just 4 companies mentioned this in the July reporting time period. About 10 companies in the May reporting time period. And so many companies that I couldn't fit them all in this slide during the January-February reporting time period. So what was a high expectation or a high hope, and that calls for optimism at the beginning of the year, has changed into something that would be nice to have if it happened, but not being counted on.
Thanks, Ben. So there you have it, folks. That's our quarterly review. We talked a little bit about markets and, again, the continued upward march that we've seen in equity markets in particular. We talked about employment, some of the positive trends there, inflation and what we're seeing and not seeing. And obviously we highlighted some of the winners and losers for both the most recent quarter as well as year to date in the equity markets. I think as we move forward and we continue to focus debt, demographics, and CapEx, in addition to taxes / regulation, however you want to put those into buckets, those are the factors that are going to be what we continue to keep an eye out on. We're going to continue to hope for improvement, especially on the capital expenditure side. But frankly, on the tax side, are we expecting a corporate tax rate reduction? Not really. And I don't know that the market is either. And I think that's something that's been a little bit lost in all the news. The bottom line is this current administration, for whatever reason, has struggled to get a lot of reform done, whether it's healthcare or tax reform. There have been challenges to that. And so at this point, I have a really hard time saying that the market is pricing that in. I also have a hard time saying the market's pricing in capital expenditures. So I think those are that's the real catalyst as we look forward and look to see where things go from here. We'll certainly stay tuned in the fourth quarter. Make sure you hit subscribe to all our content on YouTube. Check us out on iTunes, everywhere else. We appreciate you being here. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.